Good evening. Welcome to our Kansas University Alumni Homebuyer Workshop. Thanks for joining us. My name is Jason Maida. It's great to see you guys all this evening. I appreciate you taking some time to join us for tonight's class. Our class we put on once a quarter for the KU alum, and we're excited that you guys can join us on a busy Wednesday evening. I know there's a lot of different things we could be doing tonight, but I appreciate you taking some time to learn a little bit more about what home buying could look like for you. This class is recorded tonight. In fact, we're going to have that back up on our YouTube channel tomorrow. We're actually going to be sharing it with all those of you that have signed up for tonight's class. We encourage you to take great notes, of course, but certainly we'll have this class recorded for you as well. Well, again, my name is Jason Maida, and I'm with American Pacific Mortgage. We're a proud partner with the KU alum. This is our third installment of classes that we've done this year, and I'm happy to report that we've actually already got a chance to help fellow alumni with home ownership. In fact, just a couple of weeks ago, we had one of our home buyers that attended a class earlier this year purchase a home in Leavenworth, and they're now happy homeowners. So just 2 weeks ago, they got the keys to their house. But what's cool about that is their relationship with us and their experience in home buying started right here in a class like this. So, our goal is to provide tools and resources for you on this journey towards home ownership. So hopefully there's a couple things that you guys can take away from tonight's class that could help you in pursuit of home ownership. Whether that's a goal for this upcoming year or several years beyond, at least you can have some idea of what things could look like for you. Well, again, my name is Jason Maida, and so I'm with an organization called American Pacific Mortgage. We're a nationwide lender, and so what I do is I teach classes similar to this all across the country through different university partnerships. Kansas University is one of our favorite partnerships, and it's really blossomed into a really cool relationship. And so what we're going to do is provide you, like I said, some different resources for you in tonight's class. It is a very interactive session, so the runtime for tonight's class will take us up just to about the top of the hour, but we're going to weave in questions from the audience as I go through the content in tonight's class. Now, you can use the Q&A function within Zoom just to kind of log your question. I'll do my best to answer that question on air. My colleague, Ken Fleck, will also be kind of helping with some questions as we go through tonight's content. All right, well, let's go ahead and dive in. And I want to kind of first give you just a sense of what we're going to talk a little bit about tonight. We will do some budgeting exercises in just a bit, just to kind of understand what does it look like to go from renting today or not having a housing expense to now purchasing a home. What could that look like for me? And what are the benefits that come along with home ownership? We're also going to look at what's the housing market look like. We're going to kind of do a nationwide look. We'll kind of zero in on some Kansas markets. And then we're also going to talk a little bit about interest rates. A lot going on economically right now, obviously, with the elections yesterday, and now we have that kind of passed. Now we have more economic news coming out. So I want to kind of share with you kind of what's going on with the markets. I'm sure that's a top of mind for a lot of us attending tonight's class. We're also going to spend some time looking at credit, how credit can impact your eligibility. We'll talk a little bit about student loans and how we view those in the qualifying side of things. And then we want to spend some time looking at, from a high level perspective, different loan programs that are available to you, some documentation that you would want to think about gathering if you decide to pursue homeownership. And then we're going to talk a little bit about savings for homeownership. That's one of our major challenges for homeownership is how do we start a savings plan to help me on this path towards homeownership? But we also look at some assistance programs that are offered in certain markets that you may want to purchase in, as well as we're going to spend some time looking at the buying process. And so after tonight's class, you may say, hey, I want to look at homeownership a little bit closer. I want to maybe be a homeowner, just like you said one of our fellow classmates is a couple weeks ago. We're going to tell you more about how do you get on that path towards homeownership. All right. And so when we first think about homeownership, this is probably going to be one of the biggest financial decisions you make in the next few years, right? And when we think about homeownership, there's a lot of great benefits that come along with it. Now I can control my budget on a monthly basis or maybe even annual basis, right? So I don't have to worry about my rent prices increasing every time I renew my lease. This is an asset. So this isn't like buying a car, right? This asset should appreciate over time. Now, depending on where you're going to buy in the country, that asset appreciates at different levels, but ultimately over time, that asset should increases. So as we look at the value of our home, as it increases and we pay down our mortgage, the difference between those two numbers is called home equity. And for most, that's probably one of the biggest assets they have available to them. And why that's so important is because that asset can potentially create generational wealth for your family. And there's also some really good tax benefits that come along with owning a home too. So when we think about budgeting for home ownership versus like what we're paying from a rent perspective, I would say it's not necessarily an apples to apples comparison because we really have to factor all those really great benefits that come along with owning a home as compared to renting. So one of the first things we like to do when we dive into our class is to first start off our session with a budgeting exercise, just to kind of take a little bit more about how, when we integrate those benefits of home ownership, what does that look like comparing it to my situation with renting? Now, all the material that I share with you this evening, we're going to send back out to you. Not only we're going to record tonight's class, but we're also going to send all the presentation material for those that have signed up for tonight's class. So this calculator that I'm going to walk you through right now, we'll actually have that all available to you because it's all linked in the presentation material. But I always like in our classes to walk our audience through an exercise in this just to kind of get a sense of how this calculator works. Well, let's take a look at some of the fields here. So let's say I was renting at $1,500 a month in rent. And then as part of my rent budget, I have to factor in renter's insurance, of course. We're going to assume that my rent's going to go up about 5% on an annualized basis. And then we kind of side by side compare that to home ownership. So let's say I bought a $250,000 house. You're going to learn more about minimum down payments in our loan program segment, but the minimum down payment for a first-time buyer is 3% when we're doing a conventional loan product. So we're going to factor that in. We have estimated property taxes, which, by the way, will vary based upon where in the country I'm going to purchase. Homeowners insurance, the maintenance costs for my house. So, when I think about home ownership, I'm going to be responsible for any repair or maintenance of my house. And then we'll open up this tab for loan information. So we're going to assume our interest rate around 6.75, maybe as high as 7%, because rates have kind of spiked up as of late. Origination charges, so that's the cost I'm going to pay for my financing options. Now, one of your value-added benefits is being part of the KU alum, is we actually discount our services as a lender for you in purchasing a home. So we actually lower the origination cost by $750 as one of your benefits. And then you may have heard this when you're exploring home ownership or looking at online calculators, and that's this terminology around discount points. And discount points is where I, as a buyer, can basically pay more money out of pocket in order to bring down my interest rate. Now, discount points will take, let's say, for example, a rate of 7% down to 6.75 by paying those out-of-pocket expenses. So let's say I pay 1% of my loan amount in discount point. That's where I would get that 0.25% reduction in interest rate. Now, we don't necessarily recommend that in today's market. While interest rates have unfortunately kind of risen in the last several weeks, it's not necessarily something I would advise a client to do, because the reality is when I make those investments purchasing in today's market, the break-even point is about 3 to 4 years. So that means the amount of money that I'm paying out of pocket in order to create enough savings to break even, it's probably around 3 to 4 years. But the reality is, for most buyers in today's market, is that if they choose to buy in the next year, maybe year and a half, they're probably going to consider refinancing in the next couple of years when rates start to more normalize, especially with today's market where rates have kind of spiked recently. And then we also have other settlement services. So what we're looking at there is like title and escrow fees, maybe attorney fees, depending on what state you're in. Those are all part of settlement services. When we think about home ownership and from a savings perspective, we're going to generally want to set aside money for down payment, which we learned right now, it's about 3% of your purchase price, but then also closing costs. I would say my recommended savings amount would be to have the 3%. So if I'm buying for $250, I would need $7,500 for my down payment amount. But then we also have closing costs, and closing costs will vary across the country. They'll also vary based upon what you negotiate with the seller, but we recommend buyers to budget about 2 to 3% of their purchase price for closing costs and what we call as prepaid items. So we'll talk more about that a little bit later in tonight's class. The last section of this calculator, though, is going to look at appreciation. So how much is our home going to appreciate over time? How long do I think I'm going to be in my home? So for this exercise, we put 7 years, the costs of selling my home at the end of 7 years. We have state and federal tax rates that, of course, will vary based upon where you're at in the country. And then finally, let's kind of match that up against what a savings rate could look like if I decided to hold on to my money and maybe place it in a high yield savings account. So let's kind of scroll up a little bit and let's look at the side-by-side comparison from a payment perspective. So we know that from a rental perspective, we're paying about $1,500 a month in rent. Now, if I decide to move towards home ownership, now I got to prepare myself for a higher budget, right? So my budget's going to go from $1,500 in housing to about $2,100 in housing. So there's a $600 difference. However, if I was to look at the cost value opportunity over 7 years, I'm essentially when I look at what I'm going to pay in rent along with rental increases year by year, as opposed to what I achieve in appreciation in my home and potential tax benefits, I have basically about a $52,000 opportunity of owning versus renting over those 7 years. Okay. So when we think about home ownership, we want to kind of talk through a little bit more about what does that look like in terms of the benefits that I can plug into home ownership that I'm not realizing from a rental perspective. So those are the conversations that we're going to have as part of a consultation with our clients. We're going to learn a little bit more about consultations later on in tonight's class, but to kind of get us going in our discussions this evening, the budget calculator is a great way of kind of thinking through homeownership a little differently. And again, we're going to send out all this material to you tomorrow morning, so you'll get a chance to do your own calculation. I would encourage you to kind of walk through that. We'll also help you through that as part of a consultation. Well, let's talk a little bit about the housing market, and we're going to kind of spotlight the Kansas market. I know some of us are in the Kansas market, some are in different parts of the country, but ultimately, I think when we look at trend analysis, the market in Kansas, while the prices might look different than other parts of the country, the trend is not that much different. And what we're seeing right now is some of it's seasonal, where we're seeing a little bit of a leveling or maybe some softening in sales prices. This market has been a little bit different this year in 2024. Obviously, we're at an elevated interest rate market today. We're going to talk more about that in just a few minutes. But traditionally, housing markets start to pick up in April and May. Well, guess what? This year was not like that at all. In fact, we didn't see the market start to pick up until July, maybe even August, when buyers started coming out and saying, hey, I'm interested in buying. Now let me see what I can do. And I think a lot of that was attributed to the consumer mindset. I think everybody's been waiting for the rates to come back and come down, but they really hadn't moved. And so I think those that really wanted to purchase decided to enter the market, whether the rates were at 6.5 or 7%. They still wanted to get involved in the housing market. And so we have seen buyer activity pick up quite a bit. I still think there's challenges that exist from an inventory perspective. So there's just not a lot of supply out there to support buyer demand. In certain markets across the country, you are seeing builders trying to fill the gap. But at the end of the day, most resale owners, so existing homeowners, don't necessarily want to trade off that low interest rate loan of 2.5% or 3% to go buy another house at 6 or 7%, right? So that's the dilemma we're in the market. I think we are starting to see more sellers come to market. Traditionally in this time of the year, so we're in November, almost the end of 2024, you probably wouldn't see as many homes coming on the market, but you are starting to see some sellers that are just realizing the market is what it is, and are maybe preparing for rate cuts to help them on their next purchase. But ultimately, I think the challenge will remain, at least for the next year, maybe 2 years, around inventory levels. And I think that's one of our concerns on top of what we see from an interest rate perspective. Now, as I launched in tonight's class, we mentioned about a lot of things going on this week. We had elections yesterday. We have on Thursday the Federal Reserve meeting. So the Federal Reserve meets to kind of review and update monetary policy. And so what we're expecting the Federal Reserve to do on Thursday is to cut rates 0.25%. Now, previous to that, the Federal Reserve cut rates 0.5%. And you may have heard about that. It's all over the news. But ultimately, I think it's important to understand from the mortgage perspective that when the federal funds rate is cut by 0.25% or 0.5%, doesn't necessarily connect to mortgage rates dropping by that amount, but it is an indication of rates starting to drift lower. When the federal rate is cut, then we're going to see direct impact to credit cards, personal loans, auto financing. And so that's where we'll see kind of that comparison. Now, I think it's important to understand also is like, why are we in this elevated interest rate environment? If you were to look back in 2021 when rates were 3%, we started to see things inch higher and higher. And all of that was attributed to the Federal Reserve elevating that federal funds rate in order to combat inflation, right? All of us in today's session feel the pain of higher prices, right? Whether it's at the gas pump, whether it's at the grocery store, whether it's anything we're looking to purchase, things are more expensive. And so in order to combat that, the Federal Reserve has ratcheted rates up. Now, inflation is improving as a country. The inflation goal is 2%. I think right now we're about 2.6%. So if inflation continues to drift lower, then we'll still see some future rate cuts on the horizon from the Federal Reserve. Now, the other item or economic metric that the Federal Reserve is looking at is what is employment doing? That is something where we don't want employment to stall as a country. And if it is, that could cause the Federal Reserve to start cutting deeper and more frequently in interest rates. But we are expecting on Thursday to hopefully be, or tomorrow, to be about a 0.25% cut to rates. So over the course of the last 5 weeks, we have seen mortgage interest rates rise. And so one of the questions I've been getting often is, well, Jason, I heard the federal funds rate was cut 0.5% just 5 weeks ago. Why are mortgage interest rates higher? Well, a few things. I think there's just a lot of uncertainty about where this economy is going. And we did get some unexpected improvement in some job numbers. So, the way it works in interest rates is that generally bad economic news will equal good interest rates. And so we've had some good economic news, but more so some uncertainty. And so that's kind of what is kind of moving the needle from an interest rates perspective right now. Now, the question is going to come up like, what do the elections have as an impact on interest rates? Well, it remains to be seen what happens. It depends on, what policies are put in place. The Federal Reserve has their mandates. And so, a lot of what we're following right now is what the Federal Reserve does. But certainly, presidential policy can play a role in what's going to happen in interest rates. Just today, you saw the stock market go up 1,500 points. That was not so positive for mortgage interest rates, although mortgage interest rates kind of battled back a little bit today. But this is going to be an interesting economy to see how things shake up over the next several months. But ultimately, I think the trend is for rates to go lower. It's not really a if question. It's more of a when interest rates go lower. Now, as we work with buyers, I think it's important to understand that all interest rates aren't the same for all buyers. So when we think about interest rates, there's kind of different characteristics that go into what makes up an interest rate. It's credit eligibility, so my credit score essentially, the type of product I'm going to do, how much I'm deciding to finance, what does my down payment look like? We talked a little bit earlier about discount points where I can pay additional funds out of pocket. That can also help bring down my interest rate. And then generally in normal markets, the shorter my term is of my loan, the lower my interest rate goes down. So traditionally, most first-time buyers are going to elect a 30-year fixed mortgage. But let's say if I squeeze that into a 20-year loan or maybe even a 15-year loan, generally that'll bring the interest rate down a bit. But in today's market, we have what we call an inverted yield curve where long-term rates are intersecting short-term rates. So there really isn't a lot of benefit to shortening up the term of the loan. Now, what we do when we work with clients is we're going to design some options that work best for that client. So we're going to sit down and talk about a monthly budget based upon generally a 30-year fixed mortgage, and then, of course, what interest rates look like and the desired purchase price, and figure out what the best fit is. Now, credit's one of those bigger things that go into the makeup of the financing. When I think about designing home buying plans for first-time buyers across the country, there's usually kind of two challenges to home ownership. One could be I just haven't saved a lot for my home ownership, and so we kind of help design saving plans around that, which we'll talk about tonight. But also could be around credit because maybe I don't understand credit, maybe I'm a little overextended, or maybe I've had some past challenges from a credit perspective. Well, there's 3 different credit agencies that we all know of, right? So Equifax, Experian, TransUnion. Each one of those agencies have different models, different scoring methods. Not every, but different types of applications you do have different types of models too. So if I go out and get a credit card, that's going to have a different model. If I'm going to go finance a car, that has a different model. And then, of course, in home financing, there's a different model. So let me share with you kind of what the weighting looks like in terms of home financing. And if you can kind of see on screen, we have the score calculation here. So 15% is going to be how long have I had credit. So the longer, more mature my credit file is, potentially the higher my score could be. 20% is going to be how much new credit am I trying to get access to? Am I opening a bunch of new accounts? Do I have inquiries on my credit, especially in the most recent year to 2 years? Now, in inquiries, hard inquiries are what's going to impact your score here. Now, in our process designing home buying plans for clients, we always start with a soft credit check. And the reason why we do that is because we don't want to impact a first-time buyer's score, especially we don't know what the timeline looks like for them. Most of our first-time buyers that consult with me are looking to purchase in the next 6 to 12 months. So we wouldn't want to do a hard inquiry and impact someone's score if they really kind of have a longer timeline for purchasing. 30% is going to be around revolving credit. And we're really looking at what do my balances look like versus what do my credit limits look like and how much availability do I have on those. So we're looking at personal lines of credit, credit cards, maybe even overdraft protection in some cases. So let's say, for example, I had $10,000 in limits and then my balances were $5,000. Well, right now I'm at 50% utilization of credit. That means I'm accessing 50% of my credit limits. Ideally, we want to have that balance below $1,000 to optimize my credit score. Now, that might be easier said than done, especially if I'm at $8,000 in balances. Well, then my first step would be try to get below 50% in utilization of credit and then work my way down towards 10% utilization. I think kind of the measurements I would consider from a utilization perspective would be get below 50%, then get below 30%, and then optimally get below 10%. So let me give you a quick tip on how to manage your credit card debt when it comes to maximizing credit score. So if you took a look at your credit card statement, there's going to be two important dates on that credit card statement. One is the billing cycle date. So that's the date at which the credit card issuer is going to close out all the activity and report that out to the agencies. The second date is obviously your due date, right? So in fact, I was just talking to a client earlier today about this. So that particular client pays off their balances every month without fail, right? But they do it on the due date. And the challenge with that, it's not necessarily a bad thing, but at the end of the billing cycle date is when the credit card issuer sends out all the information to the three agencies. So my tip to you guys is that if you can pay off or pay down those credit balances before the end of the billing cycle date, you're going to see lower utilization and in turn is going to lift your credit score higher. Last component to the mortgage score is payment history. So that's pretty easy. 35% of the weighting, largest weighting to the credit score. We're looking at what does my payment history look like? If I've had any late payments, they get rated as 30-day lates, 60-day delinquencies, or 90-plus day delinquencies. So the more severe on the spectrum of lates I am, bigger impact I'm going to have to my credit score. If you've had late payments recently, really in the most recent 12 to 24 months is kind of the biggest impact items to your score. Now, late payments will stay with you for 7 years on your report, but the impact to the score is the most recent 12 to 24 months. Every product has a minimum credit score, and you can see those kind of on screen here. So as we're designing options for our clients, we're going to figure out the best fit, but also some of it comes down to like, what's the credit score eligibility look like? Now, as we mentioned, there's three agencies, three different scoring methods through each one of those agencies. Now, we always take the middle credit score between all three reports. So let's say, for example, my highest score is 780. My middle score with Equifax is 760, and my score with TransUnion is 740. That's my lowest score, right? Well, from a qualifying perspective, I'm going to take 760, which is my middle score, and that'll determine my eligibility for product, interest rate, maybe mortgage insurance. All that will be based upon that 760 score. Now, let's say if my partner wants to now join me in my application, but my partner scores are slightly lower. Let's say they're 740, 720, and then 700. Well, what we do in financing is we take the lowest middle score between both borrowers. So in this case, that would be 720. And so that's something we want to kind of talk through when we meet with clients to figure out what's the impact of qualifying together on interest rate or product offering. And so those are kind of things that we kind of talk through in a consultation. So I mentioned to you a little bit about, late payments, how long they'll stay with you. This kind of matrix shows you how long delinquencies will remain with you on your credit report. So as I mentioned earlier, 7 years for late payments. Hard inquiries are usually 2 years or less. But again, we only do a soft credit check when it comes to qualifying with us. And then bigger obligations like federal debt and whatnot can be on your report for 10 years or less. Okay, we're going to talk about student loans. I just want to kind of put it back to the group. Any questions that I can answer? I don't think I've seen anything in the Q&A, but any questions I can help answer? Now, I've kind of given you a lot of content already, but I want to make sure I take a quick pause. All right, let's talk a little bit about student loans, because that does come up in my conversations at least 3 to 4 times a day with clients as we're designing plans. So student loan debt is in active repayment right now, unless you have some forgiveness of student loan debt. There's different ways that we view student loan debt in terms of qualifying. If I'm on an income-based repayment program right now, I can take that minimum payment and use that for eligibility right now. So let's say, for example, I had $75,000 in debt, but my income-based repayment amount was 250. Well, then that 250 is what we use from a qualifying perspective. Now, earlier today, I met with a client that had similar amounts of debt, but their payment does not start until February on their student loans. And the challenge is there's no active repayment. So that client has to apply for repayment unless, or a payment schedule, I should say, with the servicer, or as a lender, then we by default take the total balances and use 1% of those balances as the monthly payment for a conventional loan, or if we're doing an FHA loan, 0.5% of the total balances. So it's usually more favorable for our clients to have a payment arrangement with the servicer. And so that's what our client is doing in that scenario. Now, if you have public forgiveness, public employee forgiveness of debt, where you have to pay for it for 10 years and it's forgiven, if we're still in the middle of the repayment, then we still have to count a minimum payment. I think we run into some challenges, whereas where clients are back in maybe grad school and they have a deferment, or maybe they're still in a forbearance for whatever reason. That's where it can get a little bit challenging from a student loan perspective. But I like to bring this to our audience attention as we kind of go through these workshops, because student loans inevitably come up in our conversations. Now, loan programs are going to be that resource that helps kind of get our home purchase completed, right? And so we like to talk and spotlight 5 of the kind of the core programs when it comes to financing in our classes. And so I want to kind of give you a high level look at each one of these products. You may have heard about them, but as we meet with our clients, we're going to figure out what product matches best to our goals and objectives with home ownership. So the first loan is a conventional loan. So when we think about conventional loans, that's Fannie Mae, Freddie Mac. You may have heard about those names, especially in the housing crisis back in 2008, 2009. But Fannie Mae and Freddie Mac, those occupy about 60 to 70% of the space in loan originations for home financing. Now, the way that works is with that agency, we can finance up to $802,650 in total loan amount. Anytime you go beyond that, if I'm going to purchase, let's say in Kansas or some other markets in the country, then it would be considered what we call a jumbo loan. Now, if you're joining us tonight from California, guess what? California is a high cost of living market. You can actually go higher than that. You can actually go up to 1.149 million. But the down payment dynamic changes from 3% down to 5% anytime we go beyond 802,650. That 802,650 number is actually updated every year by Fannie Mae and Freddie Mac based upon cost of living adjustments. So in a conventional loan, minimum down payment 3%. Anytime I put less than 20% down, we have a thing called private mortgage insurance on conventional loans. We're going to talk about that in just a few minutes, because that's a conversation that comes up with most clients. For a conventional loan, we're generally going to need to have a clean credit history for at least the last 24 months. So if I had a late payment in October of last year, that might be a little bit more difficult in qualifying on the conventional loan. And it does have a slightly higher credit score minimum at 620. Next product is the FHA loan. So that's a Federal Housing Administration loan, is a government-backed loan, has a minimum down payment of 3.5%. The loan amounts will vary based upon where in the country I'm going to purchase with that product. But if I'm in the Kansas market, generally it's $498, $250 as the maximum loan amount. So whether I put 10% down or 15%, basically all the FHA terms will be still set the same, where I do have mortgage insurance. And we're going to talk about government mortgage insurance in just a few minutes. FHA is going to come in and kind of fill the gap where maybe conventional might be a little more challenging for a buyer. FHA has a lot more flexibility from a qualifying perspective, lower credit score minimums, has a little bit flexibility when it comes to late payments. So maybe I had that late payment last year. It was a 60-day delinquency. FHA might be okay with that, whereas conventional might be a little bit more challenging. The VA product is going to be for our veterans that have eligibility. The VA product has much more flexibility for the veteran in terms of expenses versus income. We can go a little bit higher there, lower minimum credit score requirements. And one of the great things is the VA loan has a no down payment option. So whether I'm going to buy a house for $500,000 or $800,000, there's a zero down payment option for the VA loan product. For those that want to buy in more of a rural area, there's the United States Department of Agricultural Loan or USDA loan. That truly is a loan backed by the USDA. Zero down payment option. The two big qualifiers with USDA is the location of where that property is located, as well as there's maximum income requirements based upon my household size. And then finally, there's the jumbo loan. When we were talking earlier about clients that need to purchase maybe more than the conforming loan limits of 802, 650, that's where the jumbo loan would come into play. Higher level of down payments required on a jumbo loan, also higher asset requirements. When we think about savings for home ownership, we usually need down payment as well as closing costs. But with a jumbo loan, because it is a higher level of amount finance, they have additional asset requirements called reserves. Reserves are usually the equivalent of 12 months of my monthly mortgage payment. And then that needs to be kind of left behind after I've contributed my down payment and closing costs. So let's say I had a $7,000 mortgage payment. My reserve requirement would probably be like $84,000. Doesn't really happen a lot for first-time buyers, but certainly a resource that's available to you if you need to purchase at those higher levels in the market. So I thought we'd kind of talk a little bit about mortgage insurance. There's two kind of ways to look at mortgage insurance. There's the private mortgage insurance side under Fannie Mae and Freddie Mac. There's government insurance under FHA. So let's kind of take a look at both. Those of you that are in tonight's class, you may have started your home search and hopped on Zillow or Redfin, and maybe you've used some of those calculators on those sites. Most of those calculators don't have calibration to what actual mortgage insurance looks like. So often I get feedback from buyers. They're like, oh my gosh, I thought the mortgage insurance was gonna be a lot more expensive because Zillow said it was $300, but you're looking at mortgage insurance is like $80. So mortgage insurance has different options, first of all, when it comes to conventional mortgage insurance. You can pay for it monthly. You can split it up between monthly and upfront costs. You can pay for all of it up front. And sometimes you can actually take an elevated interest rate to completely buy out mortgage insurance. The most common option for most buyers, I would say 99% of buyers, is to do monthly mortgage insurance. The reason why that is because when I elect monthly mortgage insurance, I have the option to cancel mortgage insurance once I have 2 years in my loan and 22 to 20% equity. Now, here's where calculations in actual mortgage insurance differ from Zillow or Redfin. PMI on a conventional loan is based upon your credit score, what my down payment is, and then how much I decide to finance. So those three key factors. So that's why you'll see mortgage insurance look a little bit lower when you go through actual scenarios. So let's say, for example, I was going to purchase a home for $250,000 and I was going to put 3% down and I had a credit score of 740. My mortgage insurance monthly amount would be about $135 a month. So certainly not in that $200, $300, even $400 levels. Now, that's on the conventional side of things. If we kind of switch things up and look at the government-backed insurance on an FHA loan, it's a little bit different from a mortgage perspective. So there's two forms of mortgage insurance. There's upfront mortgage insurance, which is 1.75% of my total loan amount. There's also monthly mortgage insurance, which is 0.55% of my total amount. And then we divide that by 12 to figure out the monthly amount. Now, with FHA loans, there is no cancellation option for mortgage insurance. So whether I have 20% equity or 3.5% equity, I still have mortgage insurance in place. So essentially, the only way to exit mortgage insurance is if I was to refinance out of an FHA loan into a conventional loan product. So if we looked at same loan amount of $250,000, let's say we put 3.5% down, right? Our monthly mortgage insurance is going to be about $114 a month, but we also have to have upfront mortgage insurance, and that $43.75 gets added into my total amount financed for my loan. So as you're looking at the side-by-side comparison, you may say, well, wow, I probably would go with FHA because maybe the monthly payment amount is lower. And that's true. That could be a benefit too. But we also have to keep in mind that the FHA mortgage insurance has that upfront component too as well. So it really just depends on what's the right fit for clients. FHA is going to be a lot more flexible in terms of credit qualifying, whereas conventional might have some restrictions, especially like I said, in the most recent 12 to 24 months, maybe from a late payment or maybe overextension of credit. But ultimately, we want to meet with you one-on-one to figure out like what's the right fit for you based upon, again, those goals and objectives of homeownership. Well, one of the things we talk about in meeting with clients is employment and in income sources, right? And so there's a checklist kind of items to gather that we review in the loan process. Usually that includes the last couple of years of W-2s, recent bank statements to verify the asset side of things. But then back to the income, we look at usually the last 30 to 60 days of pay stubs. Now, if you're self-employed, we're generally going to need the last 2 years of filed tax returns. And speaking of 2 years, there's kind of rules in lending around like a 2-year history of employment and or education. So that rule states that I have to, in lending, verify that I have 2 years of education and or combined employment. So let's say, for example, I graduated from KU in the spring. I've since started my job over the summer. I've been on my job for the last 3-4 months. Even though I just started my job, I can still get qualifying for lending because I can put together my undergrad coupled with the several months that I've been on the job with my new employer. That would fulfill the 2-year requirement. It also comes in some cases where a client's getting ready to switch jobs. And let's say I'm working for ABC company, but I have a new job to start on December 1. Well, I can use that new December 1 qualifying job as long as I have an offer letter that dictates my compensation plan. Now, we're 2 years, maybe a little bit more restrictive is if I'm working for multiple employers. So let's say, for example, I work in the healthcare industry and I work for one clinic for 30 hours a week, but then I have another clinic I work for 20 hours a week. In order to count both sources of income, I do have to show that I've been on both jobs simultaneously for 2 years. Additionally, if I have, let's say, a full-time job, but also I work side employment, let's say I drive for Uber or I just do some part-time work, right? If I do want to include that secondary employment, then I have to show that both jobs have been facilitated for a 2-year time period. Okay. Last thing I want to touch on from an income standpoint is other sources of income. That could be room rents. It could be a spouse or partner that's contributing to my budget. All of those sources generally will be a little bit challenging to validate and support in an application, especially if I have a partner that's contributing in my household. If my partner is not going to be part of my application, then I probably won't be able to use that income from a qualifying perspective. And then last thing, I just want to make sure I reiterate, if I'm self-employed, so if I'm an independent contractor, maybe 1099, I do have to have 2 years of consecutive tax filings in terms of eligibility for income. One of the things we look at is we'll compare income versus expenses. We call that a debt to income ratio analysis. So if I'm a W-2 employee, we're going to compare gross monthly income versus net monthly expenses. And expenses include car payments, personal loans, credit cards, even my new mortgage payment that I'm going to be paying. Generally speaking, we don't want our expenses to be more than 43 to 45% of that pre-tax income. Now, it can go even higher than 45% at times, but we want to be cautious with that. We want to make sure that we're designing home buying plans that could create a better affordability for our clients. There's 2 big goals for us in homeownership. One is affordability, like I just mentioned. So we want to make sure we're kind of hitting the sweet spot when it comes to, hitting the right payment for our clients. And 2 is we want sustainability. We want to make sure that over time we can continue to afford our payments. So if something kind of gets off track a little bit financially, we can still be able to be comfortable in our monthly payment. So that debt to income ratio looks like this. We have the principal and interest of my new loan, property taxes I'm paying on my house, and my homeowner's insurance. And then we have PMI, so private mortgage insurance. So we're going to assume a conventional loan. We have HOA expenses. Those will come into play if maybe I'm buying a condominium, maybe a townhouse. Some single family homes will have that if I'm in like a certain community that has different benefits to it. So let's assume that my housing budget is $2,500 a month. And then my other expenses, my car payment, maybe a credit card, the sum of that is $500 a month. So right now my outgo is $3,000. If I compare that to my gross monthly income of $8,500, that means my expense ratio or debt to income ratio is 35.29%. Okay. So that's kind of how we see it on the lending side. The question I get from buyers is, well, where should my debt to income ratio be? And there's not really a magic number. There's guidelines that tell us what it should not get above, but ultimately, in working with hundreds of buyers across the country in different markets, I usually see the comfort zone around 33 to 36%. That's kind of the good number. Not to say that we can't go above that, but if I was to say, what's the target number, probably 33 to 36%, but eligibility can go 43, 45%, even 50% at times. All right, the last thing when we think about a home buying plan, and so far we've covered a little bit about product, credit, we talked a little bit about income. The other really important piece is assets for down payment and closing costs. And if you remember earlier in our class, I talked about two challenges to home ownership. It could be credit and it could be savings for home ownership, especially for our buyers that are just maybe getting started in their careers and still trying to build up that nest egg towards home ownership. Well, this is kind of what some of the documentation looks like when it comes to validating what my assets look like. Usually it's checking in savings accounts over the last 60 days. You can at times use retirement accounts, 401ks, 403bs, even IRAs. Even family members can help contribute towards your home purchase. We call those gift funds. There is no seasoning requirement for gift funds, so those can be used right away. But in looking a little bit closer at assets, I always like to talk through what we call a savings plan with clients, because it is one of the bigger challenges for home ownership. And the savings plan is a pretty simple approach. But what I would encourage a client to do, and if we were to kind of look back at our exercise that we did in our budgeting calculator when we started our class, is that if I'm accustomed to paying, let's say $1,500 a month in rent, but let's say my mortgage budget is going to take me to more of a payment of $2,100 a month, but maybe I haven't quite got my arms around savings. What I would encourage a client to do is to start paying your savings account like you're making a mortgage payment of $2,100 a month. So on the first of the month, when I make that check out to my landlord of $1,500, I take that additional $600 and I distribute it right to my savings account. It does a couple things. One is obviously that money's going to grow over time in our savings account. So by the end of 6 months, I have $3,600. Maybe by the end of the year, it's upwards of $7,200. So I'm growing that nest egg towards homeownership. But it also creates that kind of budgeting discipline that it's kind of I've grown accustomed to paying $2,100 a month. So when it comes to transitioning from renting to home ownership, it's not such a big leap, right? I've been doing it for the last several months and I've kind of grown accustomed to it. All right. So that's our savings plan in kind of designing that for, or that kind of approach for clients. Now, there also are first-time homebuyer programs that are available across the country. In fact, each state usually has what we call as the housing finance agency. Those agencies are designed to support low to moderate income first-time buyer households. So we partner with these agencies all across the country. Since our group is kind of spread out across the country, I thought we would just spotlight a national program, but I would encourage you to get connected with us after tonight's class. If you want to kind of look at a specific program in Kansas or Georgia or Texas or maybe even California, we can kind of get those resources to you. But across the country, Freddie Mac, which is what we mentioned earlier, has a national program. It's a grant essentially that provides lower income households a grant between $500 to $1,500. It's the Borrow Smart program. Ultimately, it's trying to create a reduction in out-of-pocket expense when we think about closing costs for homeownership. Other programs across the country that are first-time buyer designed will have some combination of down payment assistance funds at maybe 3 to 3.5% of your purchase price, as well as closing cost assistance programs. So depending on what income level you're at, those agencies offer different options and resources for you as a first-time buyer. All right. Well, as we're getting towards the latter part of class tonight, I want to spend some time talking a little bit about the buying process. That's one of the bigger questions that comes out of these classes or contacts that reach out to us directly. So we want to kind of give you a visual aid on home ownership. Like, where do I go from here? So after tonight's class, if I'm interested in designing a home buying plan, what should I be doing? Well, the first thing I would encourage you to do is get connected with us for a consultation. We're going to talk more about that in just a minute, but ultimately what that is that's a 30-minute one-on-one video session with me where we get a chance to work through goals and objectives of home ownership. I mentioned one of our fellow KU alum that purchased just a couple weeks ago. Well, guess what? They attended a class earlier this year, got a chance to meet with us one-on-one, design their plan, and now start this path towards home ownership. So let's kind of see what that looks like a little closer. So the output of a consultation is to get pre-approved. And a pre-approval essentially shows the framework of your financing, puts it into more of a qualifying certificate that you can share with the seller that says, hey, I'm completely qualified for home financing. The certificate is usually good for 60 days, but as I mentioned earlier in our discussion, is like most of our first-time buyers are going to be on a longer path towards homeownership, so it can easily be recertified at any time. So if I'm going to be buying 6 months from now or 12 months from now, you don't have to reapply or anything. It's easily recertifiable. Well, we issue that pre-approval at step one. But then the real fun begins, right? Now I get to move to step 2 and start looking for homes. I would encourage you, whatever market you're in, to connect with a realtor that can be a resource for you in finding the right home. It could start online and then eventually move to in person, but obviously you're eventually going to start touring homes. But we would encourage you to work with the realtor. In different markets that we serve across the country, we do have preferred realtors that we trust in creating the right experience for our first-time buyers. So we can certainly make an introduction if you do need some assistance or that resource. In house hunting, that can be kind of really the longer phase of the process. Most home ownership processes will take 30 days from acceptance of offer to actually getting keys. But what we found is the house hunting can be the longest phase of the process. Okay, so that can be anywhere between 3 to 6 months. Sometimes it can be 3 to 4 years. It just really depends. Now let's kind of fast forward a little bit. Let's say I find a home I love. I saw it online, go out and look at it. I tour it with my partner, my realtor, and we're like, this is the one, right? Then you'll submit, this is the one, then you'll submit an offer to a seller. Let's say the seller accepts the offer. Now you have a ratified or agreed upon contract with the seller, which sets terms and conditions of the agreement, as well as timelines for the transaction. So from day 1 starts generally to day 30 is when I would get keys to the house. Now that moves us to step 3, and that's called entering escrow. So now that I have the ratified contract with the seller. Now there's some action items on my side as a buyer. I'm going to have to make what we call an earnest money deposit within the first couple of days. Usually that's 1 to 2% of my purchase price. So if I'm buying a $250,000 house, I'll need somewhere between $2,500 to $5,000 as a good faith deposit towards the seller. And then within 24 hours of our acceptance, we're going to give you a call as a team and say, hey, congratulations. We now know you have an accepted offer. Let's walk you through the next steps in the process, which will include getting you scheduled for a follow-up video session so I can get a chance to review all your financing with you, make sure you feel comfortable with your payment, strategies around interest rates, out-of-pocket expense, all those important things to you as a buyer. And then administratively, we'll start other things in the process like ordering your appraisal on the home, doing other things behind the scenes to procure the financing. I mentioned a little bit more about the earnest money deposit. Again, it's about 1 to 2% of your purchase price. That goes into the escrow holding, so to speak. It is a good faith deposit, but the seller doesn't get access to that because you do have restrictions generally in your contract that allows you to do some homework on the property before finalizing the transaction. Those are called contingencies. Ultimately, the contract can be contingent on the appraisal being completed for your house and supporting the value that you're buying the house for, getting your loan approved to ensure everything is good from an underwriting perspective, and then finally getting your house inspected. So whether that inspection includes a roof inspection, foundation, sewer, whatever the case may be, doing all the things you think would be important to make a good financial decision. Well, as we move down the line here, step 4 is processing and underwriting. Those are kind of the administrative functions of the loan. We're going to be doing things like verifying your employment, verifying your assets, getting kind of everything set up so we can deliver the loan into the underwriting system and ultimately getting your loan approved. That approval process, or the from step 3 essentially to step 5, that's about a 10 to 14 day process. Can be shorter at times depending on the timeline for your contract. But ultimately at step 5, now an underwriter has reviewed your loan, approved everything. We're all now also almost about 3/4 of the way through the process. So at that time, we're going to now issue to you what we call as a final closing disclosure. Ultimately, what it does is it gives you a 3-day cooling off period before you get to the very final milestone, which is called closing your loan. And at closing the loan, that's kind of the one in-person component to the process, aside from going out and physically looking at your home. But in the step 6 process, you're going to be signing final loan documents with a public notary or maybe an attorney office. That process will take about an hour or so. At that time, I'll then be wiring in my final funds for closing. As a lender, we'll also be doing the same with your loan funds. Those funds will essentially be reconciled by an escrow team to make sure everything is contributed what is expected as part of the contract. Now, once that's completed, then documents get recorded with the county recorder's office. They'll usually record a grant deed, which transfers ownership to you, as well as a deed for the new loan. And once that's all completed, then I get a chance to make my favorite call of the day, which is to call you and say, congratulations, now you're a new homeowner. Let the fun begin, let the moving begin. It is a huge celebration because, it doesn't come with, challenges in terms of stress and anxiousness in the whole process, but ultimately, we're here to help support you in that process. And so designing and helping you with your financing really starts with classes just like this. Now, if you're thinking about moving forward in the process and want to learn more about a home buying plan for yourself, we'd encourage you, like I said, get connected with us for a free consultation. It's a 30-minute one-on-one with me. It starts with a couple next action item steps for you. One is completing an online application, which you can see some of the links here, then uploading some documents, and then finally using our scheduling system to schedule a 30-minute session at your convenience. Now, you may have some questions after tonight's call and want to maybe just get connected with us to ask a credit question, maybe a savings question, maybe even kind of what do I do next? We'd encourage you to get connected with us for an introductory call. And again, these consultations are free services we provide to all of our clients across the country. We're focusing on what does it look like where I want to buy? What's my budget need to be? Is there areas of opportunity from a credit perspective? What products match up best for me? Review that process with you so you can confidently go into the market when the time is right and look for homes. This is a consultation. We don't expect you to run out and buy a house, but we want to make sure you have all the right resources around you. Speaking of resources, we value technology in our process. We do a lot of stuff through mobile, including our mobile app. So the APM mobile app works with Android and Apple. It doesn't replace the human touch in this process. I mean, we're always available for our clients, whether it's text, phone, email, but mobile is a great resource as well too. Well, as we're wrapping up tonight's class, I know we're almost to the top of the hour. I just want to make sure that you're aware of other partnerships and classes that we have across the country. So we have KU is one of our most beloved partnerships. We have other partnerships across the country. So if you have friends, family, maybe even coworkers that are affiliated with these other partnerships we have on screen, or would just like to attend one of our classes, we'd encourage you to have them check out some of our upcoming class schedule. Our global class schedule can be found at mortgageeducate.com, but we also have a specific landing page for KU alum. It's kualumnimortgage.com. You can check a look at upcoming classes. We'll have a full-scale class schedule out for 2025 in the next 60 days that you can check out as well too. And then in our socials, we try to put out good information that's going to help you on this journey, right? So we'd encourage you to follow us at J Meda Mortgage on our socials for more information on first-time buyer programs, as well as kind of check out some of the things that our communities are saying about us. We really value our relationships with our clients and the experience we create. We're passionate about servicing our communities and homeownership, and I think there's experiences that are shared online really kind of tell the story. Well, with that said, I know I'm right up against the hour, but I wanted to make sure I think we didn't get any questions in tonight's class, but I just want to open up for any Q&A that you guys have that I can help with before we part with tonight's class. I know we are recording this class because we have several of you that didn't get a chance to attend live, but we'll definitely have that up on our YouTube channel tomorrow, and then we'll be sending out the presentation material as well. So any questions I can help answer from the audience? Okay. I think we're set. So, again, if you have anything offline that you want to kind of connect with us on, feel free to schedule an introductory call, or you can just reach out to me directly. You have all my contact information. I really appreciate you taking some time out of your busy Wednesday schedules. Hopefully we get a chance to connect with you soon to design your own home buying plan, and we wish you all a good night.